with my groupmate Jason Zhang. We're from the University of Toronto School of Continuing Studies, taking the course 3253 Machine Learning. And we're here to talk about our topic for machine learning course: Can factor investing disrupt the hedge fund industry? Mirroring global macro hedge fund performance through factor-based predictive modeling and ensemble learning. Uh, Before we begin, we want to start by giving all our listeners and readers a basic background of what hedge funds are. Hedge funds are investment management platforms that enable wealthy individuals and institutional investors to diversify their portfolio of funds to gain absolute returns that are positive risk adjusted and uncorrelated to market performance. So, if we ask anyone listening right now, has anyone invested in hedge funds before? If you did, you're more likely to have $1 million and at least 3 years of working investment experience, because that's the regulatory requirement for you to be able to invest in hedge funds in North America. Now, what makes hedge funds interesting is that the industry is valued at about 3 trillion US dollars. That's 500 times the the bailout used for the financial crisis back in 2009, with a compounded annual growth rate of about 8 to 10% for the next 5 to 10 years. Now, what makes global macro hedge funds more interesting to study than the other hedge fund strategies is that the top hedge fund, Bridgewater Associates, uses global macro strategy. And George Soros, a man who's known to break the Bank of England back in the 90s, used global macro strategies to bet against the the UK pound to make $1 billion overnight. And what makes US hedge funds more interesting is that each of the top 35 US hedge funds are more valuable in terms of dollar value than the entire Canadian hedge fund industry, which is comprised by 200 hedge funds and about 200 billion in asset under management. The research question that we're trying to answer in this study is that, are global macro hedge funds performance replicable using factor-based frameworks for non-accredited investors like you and me? So, in doing that, our objective is to assess, is there a dynamic linkage between market variables in this factor based framework that can potentially predict global macro hedge fund performance? Or is there a neutrality that investment managers, hedge fund managers, can claim so that they are worth the dollar that they are paid for? If not, the implication is we can use machine learning algorithm to pinpoint factors in the factor-based framework to replicate the dollar value that hedge fund can deliver in using their sophisticated strategies, investing strategies. So, what is our methodology? First is data gathering and preparation. We identify our target variables or feature variables. Then we predict the target using the feature, using machine learning algorithms. From there, we identify the best factor-based framework to replicate the hedge fund performance, and we use feature selection to determine the portfolio weightage that investors who are non-accredited can use to mirror this hedge fund performance, and so that they're informed in terms of index trackers that they can use to mirror the global macro hedge fund returns. In terms of exploration, our target variable is the global macro hedge fund mean index returns from the Hedge Fund Research Index Institute. We're using these three factor frameworks in the academic literature that hedge fund researchers have been using over the years. First is the Fama French four Carhart model, uh, which uses market returns, size factor, value factor, and momentum as the four feature variables to predict stock performance. The second one would be the risk based factor model, which categorizes seven risk trending variables into bond trending following risk factor, equity-oriented risk factors, and bond-oriented risk factors. And the third academic framework is the macroeconomic factor model, which uses GDP, inflation rate, interest rates, and unemployment rate, etc. The full list of our features can be found on our appendices. We use observations from 1994 to 2018, about 300 monthly data points, because the global macro hedge fund made its debut in 1992 when George Soros bet against the UK pound using anticipating macroeconomic factors to make a gain. So it's relevant that we include the 90s into this data set. Now, we do a further exploration in our data points that we did a correlation plot between our target variable, which is the global macro hedge fund, and the features within each framework. So you get the market risk, the SMB or small minus big stock performance, the value factor, which is high minus low, and the momentum. And you'd see somewhat sort of a linear trend using the four-factor model. If we look at the second framework using the risk-based model, you'd see that our target variable, the mean performance, also has a bit of a linear trend with the different features in the risk-based model. So these are the look-back straddles, or what is commonly known in finance as an option that gets the highest between a downward or an upward tick on the stock using long and short positions for bonds, foreign exchange, commodities, interest rate, and other factors listed in our appendices for the risk-based framework. And lastly, in the macroeconomic model, you'll see the different variables that we have, and there's a linear correlation again between mean and the different features that we saw. So now I'll turn it over to my partner Jason to talk about the different variables.
Okay, right now let's look at the model building process. And first of all, let's look at the target variables. And here we illustrate the correlation, the target variable with different features. So we can see there are some positive correlation and also have some negative correlations. So for our models, if we look at the distribution, it's normally distributed. Also, they have the positive value and the negative value. We have the hypothesis. We want to build two models. One is for regression, like how much could a businessman get in terms of return on investment. And also we want to build the classification models. So could they get gain or loss in their huge funds investment, because they have positive and negative value, right? So we'll look at the classification model as well. So let's look at the process we building the models. First, as we know, we have divided three groups as the features: the farmer French, risk, and the economics. And based on this, we want to build the two models and use different algorithms. Here we use three types of algorithms. One is linear algorithms, like linear regression, logical regression, and also use nonlinear, like KN and SVR. Also have decision trees and naive Bayes. Also use the ensemble algorithm, like boosting and bagging and voting. Those algorithms we have learned in the machine learning classes, so we want to compare which algorithm perform better in different cases. Then when we find the best algorithms, we want to do the pipeline. First, we need the scaling for our numerical variables and do some transformation like PCA. Then we will do the parameter tuning like gradient search for the best algorithms. And that's the whole process for our models, but we also need to know about feature importance. So here, I use random forest to find the feature importance based on their measure like best estimators. And let's look at some results. Here is the classifications. So we can see the first one, the farmer French. Here I illustrate different algorithms performance. So we can see linear regression, is performing better than the others. And here is the tuning results in different parameters, and also about the accuracy. We can see the results. And this one is the future importance. We can see which feature contributes more in the models. And the risk also economics is the same process as the former French. And we can see these three, they all perform better in the logistical regression. And we mainly use algorithms in the model building for classification. And for regression, we do the same thing, like compare different algorithm performance. And here we can see it's also linear regression perform better in terms of RSME. And also the future importance also is the farmer French performs better than the other two groups. So here we can do some summary results for the best performance models. And we can see the classification and the regression always for the farmer French, and the factors perform better. One is like 77% in the logical regression, and the other is 0.015 in the linear regression. So we can do some conclusion based on right now what we findings.
So what we saw is that given model performance, it is possible to predict and mirror global macro hedge fund performance using all three frameworks, Farmer French, risk-based, and macroeconomic models. Among the three-factor models, it's Fama French that can best explain the global macro hedge funds performance. And if we're going to do a feature-by-feature analysis, the top three features across frameworks are the market performance, foreign exchange look-back straddle, and the small cap stock performance best predict the global macro hedge fund returns. So what does it mean? It means that having index trackers that measure market performance, foreign exchange look-back straddle, and small cap stock performance will help best mirror global macro hedge fund performance. And this might potentially be the key to driving alpha. In terms of recommendations on anyone who might be interested to take this study forward, the model performance could still be improved, and the best way to do that is through data engineering work on the data set. We could still do data transformation, coefficient analysis, and outlier detection to potentially improve the results of the model. So with that, thank you, and hope to hear from you soon.